Right then, let's get started. Imagine you're standing at a crossroads. You believe the road ahead will have a massive change, but you're not quite sure a sharp turn left or a sharp turn right. All you know for certain is that staying still isn't an option. This is the exact feeling that the long-call synthetic straddle strategy tries to capture. It's a clever tool for when you anticipate a big move in a company's share price, but the direction of that move is a complete mystery. It's like betting on a horse race where you just want a dramatic finish. So what exactly is this strategy? Don't let the name put you off. It's simpler than it sounds. At its heart, it involves buying a call option and selling short the underlying stock. Think of it as two separate but connected moves. You might wonder why it's called synthetic. It mimics a more common strategy using different positions. The long-call synthetic straddle behaves almost like a traditional long straddle, where you would buy a call option and buy a put option. Using a call plus a short stock can achieve a similar outcome, sometimes with different costs or margin rules. It's like making a Victoria sponge with a slightly different recipe. Same great result. The core purpose is to profit from significant price movement, not for the faint of heart or for when you expect the stock to bumble along quietly. This is for high drama moments. Think an upcoming earnings report, a major court ruling, the announcement of a groundbreaking new product. You're positioning for the fireworks, whichever way they fly. Anticipate action and turn uncertainty into a calculated opportunity for potential gain. Now, let's be crystal clear about the objective here. When you employ a long-call synthetic straddle, you are absolutely, unequivocally playing for capital gains, not for steady income, like receiving dividends from a blue-chip stock or collecting premiums from selling options. Think of it as hunting for a big prize rather than collecting small, regular rewards. The structure bets on a big price change, so gains on one side offset losses on the other. If the stock skyrockets, long call becomes hugely valuable, dwarfing the short stock loss. If the stock plummets, short stock becomes profitable, outweighing the worthless call. All or nothing dash for capital appreciation, not a slow, steady marathon for income. The long call synthetic straddle hates stability. If the price stays flat, the position loses over time due to time decay, the call option evaporating like a puddle. Only consider this when you strongly believe a headline-grabbing move is coming and you want to profit from volatility. Success isn't monthly payouts. It's the one powerful outcome of your prediction. Did the stock move enough to make you a profit? That is the only question that matters. One of the most appealing things about the long-call synthetic straddle is its neutrality. This strategy is neither bullish nor bearish. It doesn't require you to predict up or down. You're not betting on direction. You're betting on the existence of a trend itself. Your long call option is your bullish component. It profits if the stock price soars. Your short stock position is your bearish component. It profits if the stock price collapses. It's perfect for binary outcomes. You are positioned to profit from the magnitude of the reaction. For this strategy, volatility is not just a friend, it is your absolute best friend, your confidant, and the essential ingredient for any chance of success. The long-call synthetic straddle is a long volatility strategy, which means it profits when a stock becomes more volatile than expected. If you believe a stock is about to enter a sleepy, quiet period where its price barely moves, then you should run a mile from this strategy. The profitability hinges on the stock moving far enough from its starting point to overcome the costs of the trade. Part of an option's price is implied volatility, the market's expectation of future movement. Before events like earnings, implied volatility is often very high, making options expensive. For profitability, realized volatility must exceed what the market priced in. If the event is a non-event and the stock barely moves, time decay erodes option value. After the event, implied volatility collapses, a volatility crush, further hurting the option. So you must be right about your forecast for high volatility. It's the very lifeblood of the trade. Let's start with the good news. The potential reward is, in theory, unlimited. If the stock price goes up, your profit potential is uncapped. You hold a short stock position, but your long call gives you the right to buy at a fixed price. As the stock soars, call value can keep increasing. On the other hand, if the stock falls, your profit is substantial but not unlimited. Maximum gain is capped by the stock price floor at 0, effectively bounded by the strike value minus premium. Now, the risk. The risk in a long-call synthetic straddle is strictly defined and limited. Your maximum loss is known at entry and cannot get worse. It's the premium you pay. Worst case, at expiration, if the stock sits exactly at the strike, your call expires worthless and there's no gain on short stock. You lose the premium. To make this concrete, let's use a hypothetical example with the Kraft Heinz Company, Heinz. Today is September 22nd, 2025, and Heinz is trading at exactly £50 per share. Earnings in 1 month? Whispers of major restructuring. Some analysts are bullish, others bearish. You think it won't stay at 50. To execute this strategy, you'll buy 2 options at the same time. First, buy 2 call options at £50. Second, sell shares if Americans sell 50 shares for every call. Call premium equals $2 per share. 2 calls, total cost $4 per share. $400 per contract news, stock jumps to $60, call is $10 in the money. Net profit, $10 per share, $1,000 per contract. The stock position will cost you $1,000 more if you buy them back. Ensure your brokerage account is approved for options trading. Open the options chain for Heinz, ticker KHC, around 1 month expiry. Select the $50 strike call at the money. Sell the stock. Review symbol, expiry, strike, and quantity. Submit and wait for fill. Watch price movement. You can sell to close both legs any time before expiration to realize profit or reduce loss. It's often prudent to close before final trading day to avoid automatic exercise or assignment complications. If the stock doesn't move, time decay accelerates near expiry. Consider selling remaining premium to reduce loss. Pros: unlimited profit potential on the upside, substantial profit potential on the downside. Risk is fixed and defined, and it's direction neutral. You just need a move. Cons: time decay works against you. Premiums can be expensive around events, and the probability of profit can be low if the actual move doesn't exceed what's priced in. It's powerful but challenging. Think carefully. Good luck with your trading and see you next time.